over in Japan, Japanese companies cut output for a third straight month in June. The government cut its assessment, saying output is showing signs of leveling off. For more on the latest economic figures from Asia's #2 economy, Mike Firn, live from Tokyo. Hi, Mike.
Hi, Phil. Well, we saw the jobless rate actually dropping, surprising economists, down 1/10 of a percentage point, 4.3%. There were the same number of jobs per applicant, 82 for 100. An increase in household spending, up 1.6%, but that was less than forecast. Now, today, the government approved its economic stimulus plan. One of the things it's focusing on, increasing sales of eco-friendly, fuel-efficient cars. Having said that, though, its incentives for people to buy them due to run out in August, and we did see a big drop-off in production of auto parts in June. In fact, industrial production down for 3 straight months. A couple of problems there. One is a global slowdown. The other is the rising cost of fuel.
Running a Japanese factory is like driving a sports car these days, stamping the accelerator to the floor 1 minute, then slamming on the brakes. After months of post-quake part shortages, it was pedal to the metal for manufacturers rushing to restock supplies. But this year, it was time for an emergency stop as the economic warning lights started to flash, slowing global growth, a soaring yen, rising inventories. And there's another reason to let Japan's growth engine cool. A massive bill for fuel imports caused a record trade deficit in the first half of the year. With all but 2 of Japan's 50 nuclear reactors offline, the fossil fuel bill is unlikely to drop. Japan imports nearly all its oil and gas.
Japan is between a rock and a hard place as far as its energy policy is concerned, and the import fuel bill is going to continue to stay very, very high because, quite frankly, the probability of Japan going back to 25–30% of its energy demand being met by nuclear, that seems very, very unlikely.
The government estimates that Japan's 9 utilities will pay $10 billion more for fossil fuel this business year, and that's if prices don't rise.
Most people in Japan haven't yet felt the effects, but they will do on September 1st when TEPCO raises the price for domestic users by 8.5%. It's even worse for business users. They'll have to pay as much as 16% more for their electricity.
Analysts say while price rises may limit consumer spending and cut corporate profits, some good may come of them.
The consumer is perhaps not going to grin but bear it. I think that probably some of the coming price rises will, if anything, prompt corporates to rethink some of their strategy, including establishing more branches offshore. And it's also probably going to incentivize the government to rethink its energy strategy too.
That's likely to mean a greater shift to renewable energy, but that doesn't mean Japan will get a lot greener and cleaner anytime soon. Fink says the biggest shift is likely to be towards more use of liquefied natural gas and a change in pricing policy to de-link LNG prices from those of oil.
2 utilities blaming higher fossil fuel costs for first quarter losses. Kansai Electric losing the equivalent of $1.3 billion. Chubu Electric, $160 million loss. Now, Tokyo Electric talking to the government to finalise plans to actually split power production and distribution. That could mean, when it comes into effect next year, that we're seeing lower cost of electricity, which will be good for businesses and consumers.
All right, Mike, thank you very much.